Rate cuts are not a tool for growth. Rates should actually float freely. However, now that we have accustomed ourselves to the idea that central banks manipulate the cost and the quantity of money, we must understand the ramifications of what rate cuts imply. Number one, it incentivizes public indebtedness. What we have seen so far in the past years is that governments paid no attention to the rise in rates and continued to increase deficits and continued to increase debt as it didn't matter. Now that rates are falling, the first recipient of money, which is government, will certainly benefit by allowing governments to take even more debt, and that is certainly a danger. We also must understand that a couple of rate cuts, are not likely to generate a very significant boost to the economy. No one can think that families and businesses are going to take a lot more credit just because of a 25-50 basis point rate cut, because what we see is that actually the economy is slowing down much faster than what was initially expected. So we need to be prudent with the idea of rate cuts as a huge boost to the economy, and we need to be prudent knowing that rate cuts certainly incentivize indebtedness in the public sector. However, we also have to understand that all of that means that monetary destruction, that the destruction of the purchasing power of fiat currencies is going to continue. And therefore, investing is absolutely critical in order to protect yourself against persistent inflation.